Welcome to the daily update where I'll go over the action in the market for Friday, March 21st, and we'll see how things look for Monday, March 24th. Now, it was options expiration, and that's kind of its own day, especially at the end of the quarter, which is what happened on Friday. And so it's like its own day. And we saw some choppiness, we saw some going up and down. Right at the end of the day, we saw a pretty big surge up and we ended up closing positive, but we were really more negative. It was just right at the end of the day, things popped up and were acting not necessarily the way that things were acting for most of the day. We're still negative in the short and intermediate term. We're looking vulnerable, but we're still seeing some improvements along the way. So let's go back and talk about what happened and then look at some charts. We had a gap lower open and prices fell down below S1 at 56.26 before climbing back above S1 and then chopping above and below the 56.50 level. Now, this is options expiration, so it's not necessarily a strange thing to be going around a round number like this. That could be a strike price for options. And so we went a little bit above, a little bit below. And then we did see some buying right at the end of the day. We were negative for the whole day, but we went above the unchanged level when prices moved up. We hit resistance at the daily pivot at 56.69, and we closed slightly positive and at the intraday high for the day. So when I show the chart, it looks kind of constructive, but at the same time, because it was options expiration, we don't want to read too much into that. We were up 0.08%, virtually unchanged, but we had spent most of the day below the unchanged level just to come above it right at the end. But we were way above average with volume because of expiration. Some people still call this triple witching because there are three kinds of options that expire. Then for a while, there was a fourth kind they're not as popular, and that's why I tend to call it quadruple witching. And as I said, we're still negative in the short and intermediate term because we're below the 20 and 50 period moving averages, and we're below the 200-day moving average. That's making the long-term trend still positive from a trending perspective, but negative because we're below that 200-day moving average. Interest rates didn't change all that much, and we're still dealing with all these geopolitical things that are going on, not only outside of the US between Russia, Ukraine, and how the US is involved in that, but all the changes that are happening in the US itself. Excuse me. And it's got the market kind of a little bit confused. And that's where we've been now pretty much for since about the middle of February. And even at the beginning of 2025, we haven't seen a lot of conviction. And even when we went back and set that new all-time high, it wasn't really powerful. And we're just kind of drifting around. And there are concerns that we're going to go into a recession. And that's putting some pressure on the markets as well. Because what are those tariffs going to do to companies? And what is it going to do to inflation? Okay, so some comments. Mega caps actually outperformed. So this is why the index shot up right at the end. When they do well, the S&P goes up. And it was a constructive intraday day as far as the action. And I'll show you the chart here in just a moment. We're still under 20. Now, for the last three sessions, we were at 19.9 after Wednesday, 19.8 after Thursday. We're at 19.28. No, it's still a high reading. It still means there's a lot of fear in the market, but it has been coming down and it's dropping below 20. And we still have an extreme positive reading on one of our short-term indicators, the Stoke RSI, and we're oversold still with the ADX, but now it's starting to suggest a weakening trend in the short term. And the slope oscillator is actually positive. It's above its moving average, but it's still coming up from being extreme negative. And then we still have the TTM squeeze. So pretty much all of the extreme readings have been worked off now. But you could also say the TTM squeeze is positive because it's rising. And I'll show you charts of all these things. We still have a non-confirmed Hindenburg almond. That's going to be around until March 31st. And if we don't see another spike in that chart, which we haven't seen yet, so I haven't been showing that chart, then this will fall off the books. No change to the overall scenario. The Fed is keeping rates where they're at. They've lowered their growth expectations for the economy and they've increased their inflation outlook. The dollar was up, interest rates were also up. We were at 4.25. So on a week over week basis, interest rates are not changing all that much. And you'll see that if you go and watch the weekly video. We're finishing right around this level for the past 3 weeks. Sentiment is still extreme negative. We're camped underneath that 25 level at 23, where we had been at 22, and we're still inverted with the 10 to the 3 month yield curve. We're just keeping an eye on that for right now. Now, one thing that's also changing is we've dropped below the moving average with the ADX. That means that in the short term, we've already been shown a weaker trend. Doesn't necessarily mean a reversal of the trend. It just means the big trend that we saw coming down is starting to weaken according to the ADX. We're starting to show more weakness in the intermediate term as well. So we're below the moving average, but we're still above 20. That means we are in a trending environment, but it's still negative because the red line's above the green line. And we're mixed with the bias because even though we had an up day, we spent most of the day being negative, and internally things were weaker. So that's why I put mixed there. And I'm still keeping it mixed right now as far as momentum. There's really not a lot of conviction in the market. We have one good up day and then a down day, and then maybe a virtually unchanged day. And then we go up and it's just kind of chopping around right now. We didn't have any economic reports to key off of, so there's no charts to show you there. This is the ISM. This is one of the big reports that we get, and it's economically weighted. And what they do is they compare it to when we go into recessions. And so this is something that we're going to be keeping an eye on. When we're above this 50 level, that shows expansion. And when we drop below that, that's when we're showing contraction. Well, you can see over here on the right-hand side, we've been chopping around and not showing an awful lot of strength, but we're still above that 50 level. And we've been above it now for quite some time. And that's kind of holding things together economically. Then let's see. It says all bears start with a correction. So that's how bear markets start. But not all corrections turn into a bear. And this just shows over a period of time when we set an all-time high and then started to see a decline, because the typical definition is when we set a high and then fall 20% from that high, then we're in a bear market. And you can see most of the time we do see corrections, but they don't necessarily turn into a bear market, but sometimes they do. And then looking here at what is the return so far of the Magnificent Seven stocks versus the rest of the stocks in the S&P. For the last couple of years, 2023 and 2024, this chart was reversed of what we're seeing now, where the Magnificent Seven stocks, they're actually down 12%, and this is before Friday's session, where the S&P itself is down 3%, where if you look at the equal weight version, or the not the equal weight, but the rest of the stocks that make up the S&P, they're actually up 1%. And that's what we're seeing. That's what I keep talking about in the videos. We're seeing rotation out of growth, which is the Magnificent Seven, going into value, which are stocks that are more defensive, and folks that have to stay fully invested all the time. If you're a mutual fund manager or an ETF manager, you can't go to cash. You can't jump over to the bond market. You have to stay in the stock market. And we're seeing a lot of repositioning that's still continuing. That's why growth has been underperforming value and even not really going anywhere right now, but showing some weakness. And so that just means that the rest of the S&P is actually outperforming the stocks that usually lead things higher. And then the number of calendar days the correction lasted for the S&P 500, this was very short. This was when we declined in the middle, we hit the high in the middle of February, and then we've been declining. That was considered to be a very short period of time. And you can just see some of these are very short, some of them actually last quite a while, like 1929. I bet all of you remember that one. That seemed to go on and on and on there. And the S&P sell-off has been sharper than the average correction over the last 100 years. This just kind of says what I mentioned. The orange line here, this is when we set the all-time high, and then we went down quickly after that. Then this isn't as applicable now. It would have really applied more to Friday's session. But this is why options, when they expire, especially at the end of the quarter, we kind of just step back and say, okay, this is its own day. Because just for the S&P, there are $2.8 trillion of options that are getting ready to expire. And then there's other ones. And this is just looking at SPY options. And that's 1.7 trillion. I mean, that's a lot of money. And so this can have a real impact. There's a lot of maneuvering, and folks that were looking at profits are now looking at losses and vice versa. And it it can just make that day kind of crazy altogether. Then the Goldman Sachs sentiment indicator actually dropping down, but we're still above the zero line here, but we're not above this one level, meaning that folks are not really positive about things right now. And that's what we're seeing in a lot of our other sentiment indicators. Let's see, I found one chart interesting here. This is the tech sector, and this is actually kind of encouraging because this shows earnings are still going up. And so that produces some hope when we look at the tech sector, which is really what drives the market. It's such a huge part of it. And the fact that this line continues to advance is positive for the market. Then here's the intraday chart where we turned negative. We went negative about the time that Europe opened, and we just stayed negative, and that produced a gap lower open. But you notice we came down right about to the same areas that we were at back on Tuesday. We didn't really break down below that, and we just kind of set up a base here. We chopped up, chopped down, and then we saw a little bit of a move up here. Could not get back to the unchanged level until right at the end of the day. And then we closed down just a little bit below the daily pivot. And then things were virtually unchanged just as we get ready to settle things for the weekend here. This is still part of the defensive scenario. Excuse me. I'm sorry about that. This is part of the defensive scenario that I've been talking about, is that we're still seeing the red line above the blue line. That means on an intraday basis, value, which is more defensive, is outperforming growth. We want to see the blue line above the red line. And we're not seeing really much of a change here. It's not breaking down, but it's not breaking out when we look at the intraday chart of S&P growth to value. So on an end of day basis, growth was up and value was down. And for the mid caps, growth was also down, but down less than value. The middle area, these are the ETFs. Like this would be SPY right here in the middle area, even though I don't think it was up 0.7%. Okay. And then for the small caps, growth was down, but down less than value. And so this is what I'm talking about with our growth to value ratios. We're still positive because the blue line's above the red line, but we're below the red line, which is the 200-day moving average. And we've just been chopping around lately. And we're seeing a little bit of an improvement with the mid caps, longer term uptrend, but underneath the moving average, but finally was able to get back above that. And not really much of a change with the S&P growth to value ratio on an end of day basis. Still looking more negative here since we're below the rainbow. When we look at this growth to value study, we did pop up a little bit, but it really hasn't been showing much conviction. Also, same thing with discretionary to staples, just kind of hanging out around the 200-day moving average with the ratio. This is the short term now where we've actually rolled over and we're going underneath the moving average. It doesn't mean a reversal. It doesn't mean we're going down. The ADX does not measure direction. It measures the strength of the trend, whether it's positive or negative. Well, it was really going up. The trend was going up here as far as strength as the S&P was coming down. And since we've been kind of chopping along sideways right now, that's why we're seeing this coming down. But it's still negative because the red line is above the green line. And now we're finally starting to cross below the moving average in the intermediate term, but it's still negative because the red line's on top, the green line is on bottom. And we saw just a massive increase in volume. You can see it here on our volume chart. We were well above average. But pretty much throughout the week, whether it was an up day or a down day, we've been below average with volume lately as folks just see this lack of conviction in the market and they're not really enthused to throw money into it. All right, then looking at sentiment, this is the euphoria meter, which is like a composite, where we had been getting extreme positive here above this one level, and now it's starting to come back down. This is a longer term chart, and it's holding up a little bit better than some of the other charts we look at, like this one, the Ulcer Index. We're still seeing a lot of fear here, but it is starting to come down. And we're below 20 again with the VIX, at least on a closing basis. We might go a little bit above 20 during the day, but we end up closing down below 20, and that's a little more positive. And when the VIX is coming down, the VIX of the VIX is also declining as well. The momentum of the VIX, as measured by the MACD, is down. We went up with this fear gauge because we spent most of the day negative, and we were up a little bit with this other fear gauge there. And we actually came down a little bit with the equity put call ratio. And so we're actually coming down, and this is positive. With the 5-day chart, that means there's less hedging. Folks are a little more positive. But we've been getting some really strange readings here and not seeing an awful lot of extended conviction. We just are chopping around quite a bit. And with the 10-day, we're coming down as well, which is considered positive. And we're below the band here with the volatility risk premium. That's considered more positive. When this goes up, that means the market's anticipating more fear. All right, and the advanced decline line still continues to hold up. We've just been going sideways, but it's positive since it's above the moving average, and we're also hanging in there a little better based on volume. And we actually dropped negative with the advanced decliners over a 10-day period. We had come above the zero line to turn this positive. Now it's dropped down below, but you can see this has been really choppy. We're not seeing any big swings that show more conviction. This is improving though, but we saw an expansion of the new lows on Friday. We're turning back up with the 5-day chart, and we're still coming up but leveling off with the 10-day chart here. But we're seeing, for the most part, except for Friday, we're seeing more blue than green, which is more positive internally. And we're coming right back down to the moving average with the S&P advanced decline line, where we're still below the moving average with the NYSE common stock, mid caps, and small caps. And we really turned up here with accumulation distribution. Now, some of this could be attributed to options expiration, but this is smart money indicator number one, which is positive. And we're actually dropping a little more negative with our advanced decline ratio. And we're turning a little more positive now with the chicken money flow. The histogram went up enough to actually turn back positive. And we're going up with the Chaikin oscillator. So for the first time in quite a while, we are seeing all three of our smart money indicators positive at the same time. But we're just not getting confirmation of that from our other charts that things are positive. And like this one, the vortex, the red line's above the green line, that's negative. And we're still below 50 with those stocks in the S&P above their 20-period moving averages. That's negative. We're also negative with the 50-period moving average study, 100-period moving average study, and 200-period moving average study. And we really spiked up with volume here as we remain below the 200-day moving average, which is acting as overhead resistance. And we declined just a little bit, but not all that much with the 20, 50, and 200-period moving average study. We're extreme positive with the Stochc RSI. It's picking up some of this upward move that we've been seeing, and that's why we're getting an extreme positive reading. But this is not being confirmed by any of our other short-term charts, like the Williams percent are. It's going up, but it's still below the midpoint. And same thing with the CCI 14. It's below the midpoint. And the CCI 20 even has further to go just to get back to the midpoint. Usually, when we're seeing a more convicted move, we're all of these indicators that I just went through, the Stochc RSI, Williams percent R, CCI 14 and 20, they're all extreme, either positive or negative at the same time. And we're not seeing that right now. We're actually, for the first time in a while, we're not extreme with the stochastics, either in the short, intermediate, or long term. But please remember, long term means long short term, intermediate short term, and short short term. This top stochastic is faster, then this is more medium, and this one goes slower. But they all are used to measure the short-term time frame. And we improved, but we're still negative with the force index. And we're trying to turn back up here with the condition of the short-term trend. We're above the blue line and the green line here, but we're still below the simple and exponential moving averages. So that makes it negative. We're in the -1 channel with our standard deviations chart and coming right back up to zero now. This is at equilibrium with the balance of power. And a little more positive with the lighter shade of purple instead of the deep purple colors here. And bouncing up off of the lowest low value. So there's still some improvement going on here. And this is actually, you could make a case to say that it's positive. Lighter shade of red and going up, even though we're still extreme negative with the TTM squeeze. Improving, but still negative with the ease of movement. Still negative with the Arun indicator since we're below zero. And we drop back to negative with the McClellan oscillator for the S&P, but you can't really see it. We're turning down just a little bit here based on price, but we're still going up based on volume. And we're right down here, just barely positive with the McClellan oscillator for the NYSE. So we're still going up with the summation index based on price and volume. And we're actually looking more negative now with the Swanland trading oscillator. We're turning down based on price and volume, but we're still above zero with both of these. Momentum is trying to improve, but is still negative. We're starting to cross back above the moving average based on price, and we've already crossed above the moving average based on volume. And just kind of dancing around here, not showing a lot of conviction with the PMOs that are rising. We are seeing the buy signals advancing, but we're flat with the PMOs that are above zero. And we continue to be neutral with the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR. We continue to be negative with the intermediate term trend since we're below both of these lines. And we're below all the moving averages. And now the short-term moving averages, they're starting to come down and actually cross below the longer-term moving averages. And we're still having a difficult time with this light blue line. This is overhead resistance that we just can't seem to get above. And we're not only seeing it on this chart, but we're seeing it on the 200-day simple moving average with the SPY, which is the ETF for the S&P. And we're seeing it on some other charts that I'll show you here in just a moment. Now, this you could make a case for being positive, even though it's giving an extreme negative reading with the short-term slope oscillator. We're finally starting to turn more positive with the MACD. It's crossing above its moving average after getting extreme negative. And here in the short term, you could say we're back to looking positive on a momentum basis. We're starting to turn positive and showing an improvement in the intermediate term. We're still going down, and these are just starting to turn a little bit with our long-term oscillators. We're positive now with the copy curve. It crossed above the red line. And we're no longer extreme with the Sean trend meter. We're still negative with the money flow, and we're positive with the ultimate oscillator. You see how these indicators are kind of mixed up right now? And we actually crossed back above the moving average with unbalanced volume. That's turning it more positive. But we're still below 50 with the RSI 14 and the RSI 9. And we decline now with the bullish percent index. This had been positive and climbing. It came back down in Friday's session. We also declined, not very much here, with the NYSE bullish percent index, and we were down slightly with the NASDAQ 100 bullish percent index. Still waiting to see if we get a signal here, down here below the red dashed line. It hasn't happened yet. This is another area of overhead resistance, which is the 61.8% retracement level from the low a year ago in April to the high set in February. We cannot seem to get above that. But on the other hand, we've been holding above this 50% level. We lost it there for one day, but we quickly got it back. So it's like we have overhead resistance above current price, but we still have longer term support. And we're also seeing that longer term support here with the weekly chart that we are still above this long term pivot. So longer term support is still holding. And kind of a little bit, we were improving here, but now we're turning a little bit more negative with the Heiken Ashi chart. We're positive, but pointing down with the Kegi chart. We're negative with the Renko chart, and we're negative with the three-line break chart. Long term, we were seeing more of an improvement with the 150 and 200 period moving averages, but now they've been declining over the last few sessions. And no changes here. negative in the short and intermediate term with all the different stock indexes that we follow. No changes here. Bonds are positive based on price in the short and intermediate term, positive across the board with commodities, and still negative with the dollar in the short and intermediate term. And this is actually kind of encouraging. The three growth areas, they were the positive sectors: communication, discretionary, and tech. And we like that. So all the other sectors ended up being negative in Friday's session. We saw negative things at the open and then some positive things going into the close, where initially the Nasdaq it went below 17.6, then 17.5, then it reversed and got above 17.7, and the Dow was able to get back above 42,000. And Canada was having a little bit of trouble early in the day. This is what we're watching on the Dow. This is the 200-day moving average. It was the last major index to lose its 200-day moving average. We'll see if it's more positive. It should be the first one to get it back. If it doesn't, then that's going to mean things are more negative. We're still neutral with the diamonds. Looking at the Elder's Impulse system, no real change here with the Nasdaq, still holding out above this S2 support level. Pretty much that same thing with the Nasdaq 100, just kind of chopping along right now. Still neutral with the Elder's Impulse system for the triple Qs. And we're starting to turn positive though with the momentum. We've seen enough of an upward move with the Nasdaq 100 to actually turn this up. But we're negative here with the S&P 600 small caps. Recent death cross here, still just not doing all that well. Still holding up for the time being above this S2 support level. And then the other small cap index that we follow, we almost got back up to 50 with the RSI. That would turn it more positive. Now we're coming back down. We're starting to see a death cross here with this index. The momentum is still positive though, but we're neutral with the Elder's Impulse system for the small caps. Still kind of hanging out above this S2 level with the mid caps, and neutral with the mid caps according to the Elder's Impulse system. Still below the 200-day moving average with the broad market Wilshire 5000 and the broad market total US stock ETF. This could be encouraging. We're coming down here with the staples to tech ratio. When this is going down, that means tech is outperforming. But we're just about getting ready to see a golden cross with this ratio, meaning that on a trending basis, staples are starting to outperform. But we saw that earlier in 2024, enough to generate a change in trend. And then that was about the time that everything switched back and favored tech over the staples sector. Financial sector doing okay, but still below its 50-day moving average. The FANG index hanging out either a little bit above or below its 200-day moving average. And then Apple was up 1.95%, but still below its 200-day moving average. Still below the 200-day moving average with Amazon. Microsoft is in a downtrend, but was up in Friday's session. Google below its 200-day moving average as well, and trying to bounce off of the 200-day moving average with Meta or Facebook. And then Nvidia, we're starting to see a death cross here with the longer term trend, and we're below the 200-day moving average. Tesla, still in an uptrend, but looking kind of in danger right now. It was up over 5%, but still hasn't come back up to its 200-day moving average. And Netflix is a little bit above its 50-day moving average. This stock has been holding up a little bit better than the other Magnificent Seven. And not seeing much of a change with the short-term correlation between US and world stocks. Still seeing the longer-term correlation weaken between the two. And oil is back down into the upper 60s now. The dollar did bounce back up. It's still in an uptrend when we use moving averages, but it's below its 200-day moving average. And we were up a little bit here with the 10-year yield. We were down with the 10-year based on price. Not really seeing any improvement here with our growth to value ratios. To Qs to S&P, discretionary to S&P, large cap growth to large cap value, still below declining moving averages. And we're still declining with the large caps coming back up to the moving average with the mid caps, but the moving average is still coming down and still below a declining moving average with the small caps. This could also be positive. We're seeing this spike up. That means that staples were outperforming the S&P. That's more defensive. When this starts coming down, that could be more offensive. If we continue to drop, that quite often will be positive for the S&P. So what's our outlook for Monday? We're still negative in the short and intermediate term because we're below the 200-day simple moving average. But longer term support that I showed is still holding, and we're seeing some signs of improvement. And we're going to get the global manufacturing and services PMIs in Monday's session. And then who knows what could happen over the weekend that has an impact on the market. Here is the economic calendar for the upcoming week. I haven't marked these as which ones are really important, but kind of the big one, we're going to get GDP again, but we've seen that number twice now. And unless it's really different, probably won't have an impact. But we're going to get another inflation reading in Friday's session. And here's also a look at the calendar. Seasonally, not very good for March 24th. We're negative with the Dow, neutral to negative with both the S&P and NASDAQ. Now we're going to be entering the week after options expiration where we're down more than we're up. We're down 38% of the time and up 62% of the time. See, we're up 38% of the time, down 62% of the time. And this is where we might see some negative seasonality. But during a post-election year, sometimes we're more positive as we work our way through this. And the second half of March should be performing better. And just like the first half was supposed to, but it didn't. All right, so we're seeing more of a mixed picture right now with, again, with our smart money indicators. I should have changed this. We're actually more positive with this. We're above the moving average with accumulation distribution. The Chaikin money flow is turned back to positive, and we're actually turning back to positive with the Chaikin oscillator. So that this part's incorrect. And the bullish percent indexes are back to going down now. The only one that I really measure and look at is the S&P. I just watched the NASDAQ 100 and NYSE bullish percent indexes. And we're back to negative with the S&P McClellan oscillator, so we're ticking down based on price. We're still going up based on volume with the summation index. We're seeing some improvement here with momentum. We're turning positive in the short term. We're improving in the intermediate term. We're still looking negative in the long term. And then we have a long-term oscillator called the special K. That is still negative. Swollen trading oscillators back to negative. We're still below 50 with all of our moving average studies. The ease of movement is negative. The money flow and the vortex are negative. And then we're just starting to cross above the moving average with the NASDAQ 100. Another good day or so, and that could actually go over to the positive side. And looking positive, as I was pointing out, the longer term trend for the growth of value and discretionary to staples ratios are positive, but they're all hanging out around their 200-day moving averages. And we're going down with the 5 and 10-day equity put call ratios. The NYSE McClellan oscillator is still positive, so it's still going up for the summation index. Parabolic SAR is positive. The Copic curve is positive. The financial sector is positive, and the bank ETF's just kind of it's bumping above or below its 200-day moving average. And the ultimate oscillator, it's actually positive. So our conclusion, we're in negative. I haven't changed this. Negative in the short and intermediate term. We're mixed, but still considered positive in the long term. But we're seeing a real mixed picture right now. And in the short term, we're negative, and there are some improvements as we're seeing some improvements in the intermediate term. But the market is also vulnerable at the same time because a solid down day could wipe out all of the improvements that we're seeing. We need to see more conviction to the upside, and we're still positive in the long term, even though we're below the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a wonderful day and a wonderful weekend, and I will talk to you in the next video.